Welcome to Capitalizing Your Life, the podcast that shows you how to take control of your money, build lasting wealth, and create financial freedom using the infinite banking concept. If you're ready to make your cash flow work for you instead of someone else, you're in the right place. Here's your host, Glenn Yaney.
What's up, and welcome back to another episode of Cash Flow Conversations. Today, we're going to continue our conversation with Glenn Yaney out of Florida, who's a real estate investor who fell in love with the use of life insurance to help a balance sheet issue that he had when he was dealing with banks. So we're going to start from the beginning here a little too. Some of the beginning origin of your story, Glenn, we kind of skipped over last time, but I think it's so important to talk about because you follow any Dave Ramsey fan and they're all about paying off that mortgage. And when we talk about cash flow, that might be the last thing you want to do is paying off your main mortgage. So Glenn, it's good to have you back, bud.
Great to be on. Happy to be on.
Good. All right. So you were telling me the other day about one of the mistakes that you made in the beginning of your cash flow journey and how you're selling assets in order to keep things going. So kind of start from the top with that mortgage idea.
Yeah. So whenever I first got into real estate, I can tell you there was a few things that made me unsettled. And a lot of it, if you buy a single family home with minimal leverage, we're talking about 5%, 20% down, you're generally going to cash flow around $200-$300 a month on a good property. And that's if it's a good property. So what my rationalization was I was like, I'm going to pay this thing down to get more cash flow. And
because once it's paid off, the money that you were using to the mortgage, you can then invest. What a novel idea. You're the first one to think of that.
Yeah. So what I started doing was I started getting into what is called velocity banking, where I would take a line of credit. I took a line of credit on the house that I owned, and I started paying down my mortgage. And I had this goal of my mortgage being $500 a month. I think it was a limiting mindset because I always thought that if I ever have to go back to Red Lobster, I need to be able to pay this mortgage. So I ended up getting that mortgage down to $500. So I paid the house off by $90,000. And what ended up happening is once I did that, I did feel better. I thought, wow, I only had to pay $500 a month. That feeling did feel good. But if you looked at the amount of capital that I put down I would say it was about a $500 savings on a $90,000 investment. That's below 10% return. And so what I ended up doing is I ended up getting a bigger line of credit on my house. And I ended up finding a new property. And then at this time, I looked at it as I was almost like house hacking. I had a family, I had a 1-year-old baby, and I thought, I'm going to move over to this other house and let the current house that I'm in pay my mortgage. And that's exactly what was able to happen. My new mortgage was only $1,500 on the new house. So then the about $1,000 of cash flow that I had from the first house. And what ended up happening is I ended up maxing out that line of credit because I renovated the new house. And then, so I felt the stress of that line of credit of being maxed out. And what I had is a self-directed IRA. It was called a QRP at the time. So I'm very familiar. There's lots of rules. We don't need to go into them. But I was going into start doing self-directed IRAs through a QRP, and which is called Qualified Retirement Plan. And it's pretty much a 401k instead of a self-directed IRA because there's called this UBIT tax. It happens when you have leverage on a property. You actually have to pay taxes still with a self-directed IRA with leverage. See, your accountant. But so what I ended up doing is I had this access to this QRP, and I thought if I just cash this out, I would be able to pay off this line of credit and I would be able to buy more real estate to create more cash flow today in my life compared to when I'm 65 years old. So I had to figure out how to pay off this line of credit somehow. And the only way I could come up with is this big account that I had over here. It was about $90,000 that I withdraw. And I just looked at it as I would take the penalty to become financially independent today is really what it came down to. And this is before I knew about cost segregations, but it was really, I read Killing Sacred Cows by Garrett Gunderson. And I realized that the penalty was worth it to be able to have access to more capital.
Which is a very unique thing. A lot of people look at that and say, I would never pay the penalty. But you looked at it and said, I can put it in a place that can generate cash flow before retirement. And then after you learn about the cost seg studies, how did that change everything?
It pretty much, the cost seg thing was just the key to open up the rest of it. I had about $300,000 in my 401k between mine and my wife's. Like I said on the previous episode, that my wife was going to work and not receiving a paycheck. She was putting 100% of her pay into a 401k. I was sold on 401ks, stock market, index investing. But I learned that you can only have one master. Like it's either if I wanted to become a successful real estate operator, I need to go all in. I learned giving my money to Wall Street, in my opinion, is a mental mindset that I'm not good enough to be able to invest my money myself. So that's why I don't do it. I look at it as, maybe I would do okay if I put my money in an index fund, but I believe that there's a mental block that tells me that I'm not good enough to be able to invest my own capital. And I think that it takes away the experience that I would have if I went to go invest it myself also. So that's why I no longer put money in the stock market and I focused on just investing in myself.
What you did, we've talked about in the past, is this idea of ownership.
Yeah.
And you owned the problem, and you said, no one's going to fix this except me. And I think every entrepreneur has a level of ownership in most of their decision-making processes. They own the problem. They see what they want in the future, and they're going to take action to get it fixed. So being able to take action is one thing. So talking about a problem is easy. We know people that can talk about problems better than anyone, but what are you going to do about it? So when you took the $300,000 out, you didn't even know what cost segs were. Then you find out what cost segs are. How much tax did you end up paying on that $300,000? Now, everyone listening, this is not tax advice. This is unique individual circumstance. Before you make any financial decisions or tax decisions, consult a licensed professional. That's my disclaimer. Obviously, we're just talking about this having fun. But what was your tax bill on that $300,000?
Yeah, so I did time it. So I took out 100,000. Well, I took 90,000 out in 2020, and then I took 100,000 out in 21, and then it was December 21, and then I took it out in January 22. So I was able to access it almost back to back.
Yeah.
Once I started understanding that my penalty was 10%. And then on the first year, I got lucky. I pulled the 90,000 out during CARES Act, but I pulled it out before CARES Act actually happened. So they actually didn't give me the 10%, and they let me pay the taxes over 3 years instead of having to pay it all in 1 year. It worked out, but I didn't plan on doing that. I was planning on paying the full penalty,
So when you took the money out and put it into real estate, how did the cost seg help you? Explain how that worked to everybody.
As a real estate operator, you have to qualify through having a real estate professional status. It's not a license, it's a status. It's based on so many hours worked a year and really the amount of money you make from real estate compared to your other earned income. So I think it's over 50% of your earned income. And I believe it's 750 hours a year. A lot of people ask me about it because they know about the story and I'm not, obviously, we're not telling you what to do, but that's what happened for me. So in that scenario, we bought the first park was an $850,000 park. We put about 400,000 down through CapEx and also down payments. And we were able to deduct about 550,000 on the first deal. And then all three of us were real estate operators. So we divided that 550 over the three partners. So I think I came out with 175 in depreciation, which goes directly against my earned income.
Or the distribution from the QRP.
Yeah, this was a real 401k. I had 90,000 in the QRP, but then I had it in a regular IRA. But the other thing that also I would say about the accelerated depreciation is that if you're an investor and you have a lot of investments out and you're constantly buying and selling, a lot of people talk about the 1031 exchange. But if you have this accelerated depreciation, you can actually offset the capital gains and get yourself at a higher basis on your new purchase. Because when you do a 1031 exchange, like my first purchase was a $50,000 condo, my basis is 50,000. So if I made 115,000, which is what I did, my basis is still based on the 50,000 whenever I go to do a 1031. But if I were to do a cost seg study on like a mobile home and I sell that $50,000 condo for 115, I actually can wipe away those gains through the accelerated depreciation also. So it would still be considered passive income and it goes against my income and I could still write it off against that. So that's the other thing is that with accelerated depreciation, if you're not a real estate professional, you can write it off against your other assets as you're selling them, buying and selling them is really what it turns into.
Only on the sale if you're not a real estate professional.
Yeah, because there's still capital gains tax, but you can also offset those capital gains tax through the accelerated depreciation.
Nice.
Which is paper losses, really.
So you went from Wall Street to real estate.
Yes.
And the IRS has all these incentives of ways to make it attractive.
If I could make a quick correction on that,
Yeah.
I went from shotgun approach where I wanted to buy real estate, I wanted to invest in my 401k, I wanted to day trade, all the things that you can do, buy Bitcoin, all of it. And what I did is I got focused. And that's what I said. No longer can all my capital flow in 4 different directions. It needs to flow in one direction.
Riches are in the niches.
Yeah.
Hormozy says, if you don't have a niche, I'll niche slap you. I love it. So you're taking ownership. You pivoted your strategy based on what you learned. You weren't too egotistical to say, I know how this works. I'm going to keep going where I'm going and then complain about the results. Talk to me a little bit about your thought process of paying down the house. You talked about it a little bit, but your mortgage was set at what?
I mean, the mortgage I think was 2.75.
2.75%. Now, if anyone can get a 2.75% mortgage, it's a guaranteed loan that is guaranteed not to change for 30 years. And a lot of times you can deduct the interest. It's almost free money for 30 years.
I would also add being a real estate investor. And if you want to buy a lot of real estate, you're going to need to find investors. So when you have a 2.75% mortgage, you have to look at that as your best investor because that person's wanting to be paid back the least amount that you'll find. So it's like if you pay down that investor at the time, what I would say is, or even now, if I did that, I would say it's almost like me being ungrateful for this investor and I'm giving him his money back. And thanks for giving me 2.75. I don't need it. I'm going to go find somebody that I'll pay 10 to 12% or whatever the number is.
Wow, I think that's a great way to look at that. You got rid of a phenomenal business partner to pay somebody 4 or 5 times more.
Exactly.
Now, this isn't for everybody. Like, I know a lot of people that are happy at their job, funding the 401k, and they're going to do this when they get to retirement because there's not a person on this call or on this watching this that's not retired and has used the 401k for cash flow or for income, unless it was a hardship or they did what you did. These people who don't want to take ownership in these issues that we're talking about are going to get to a point in their lives where they're 65 years old or 70 or 73 when the IRS says you're going to be forced to sell this. And what's the strategy? Just pull money out? Well, if the market's going up and down, when the market's down, that's the worst time to pull money out. So diversification and success, if those people believe in diversification, then you would believe that you'd never sell when the market's down. And if you stay in this traditional retirement account, you're going to be forced to sell when your account is down after RMD ages. So you have $1 million, you're 75 years old, IRS says you've been kicking this tax can down the road long enough, you're going to be required to take out at least 4.5%, 5%. And the bigger the account, the more that you have to take out and the more taxes that you end up paying on that. So it's a terrible way to create cash flow. It's a phenomenal savings tool, but you can't use it. It looks good on paper until you say, hey, send me the money. And then that's when your accountant or advisor says, how much should we withhold in tax? What tax? Dude, you know how many people I've met that go, yeah, man, once I reach 60 years old, my retirement account's tax-free.
Yeah.
I'm like, no. They're like, yeah, after 60, you got to wait till 60. I'm like, no, that's just the penalty. At 60, the penalty goes away. You still owe federal, state, local, Social Security, maybe IRMA. You're going to owe 5 taxes. You postponed maybe 3, maybe.
Hey guys, if you'd like to learn more about the infinite banking concept and how to flow your capital through your own financing system, my team and I are here to help. With over 35 years of experience, we can guide you in building a properly structured whole life policy tailored to you and your family. See the scheduling link below. Now, back to the show. There was a viral Grant Cardone interview where the guy's interviewing him, and he totally had no idea, the interviewer.
That's a great one. It's like Vlad or something. The guy's like, I'm not going to say it on the air, but he said it. And then Grant's response was like, I feel bad for you.
Exactly.
He goes, I feel bad because you can't use it. And then the commentator's like, no, it's tax-free. It's tax-free. Grant's like, no, it's not.
Yeah.
But here's the thing. If you're an entrepreneur, you believe in ownership of problems.
Yes.
When would you want to figure this out? Today or the day that you retire?
Yesterday.
And you know why the advising industry doesn't talk about this? So for all the listeners out there that go, my advisor never told me this. I know they didn't. I'm not surprised. Here's why. If you were an advisor, Glenn, and you charged a fee to manage money, what better account to manage than one that the client's not going to touch until they're 60? So it hopefully just keeps going up.
Yes.
Right? So the money's locked in. Furthermore, there's a tax lien on that account that we can't even quantify. There's not a CPA in the country that could quantify the tax lien on a retirement account because we don't know when We're going to take the money out. We don't know how much. We don't know what tax rates will be. So no one knows. However, I know that if I show $1 million in my account, if I pull it all out, I'm going to owe tax. Okay. If you're an advisor, would you rather manage a pre-taxed account, one where the tax lien is in the account, or a post-tax account where somebody already paid the tax? Which would you rather manage?
The one that's already paid the tax.
The one that hasn't paid the tax.
Oh, yeah, the one that hasn't paid the tax because you're paying it on the basis.
Advisors are legally allowed to charge fees on money that has to go to the IRS.
Yeah.
The IRS doesn't share in your fee structure. They don't share in your risk, but they share in all of the gain, all of it, for generations. Now, once you pass that retirement account to your kids, well, first it goes to your spouse. Now it's a single taxpayer, which increases taxes 20, 30% on your single spouse. That's the condolences that you get from the IRS. Sorry, you're going to pay more now. And then when your kids get that, they're forced to take that account and get it to zero in 10 years.
Yep.
Forcing them to take out more money than what you had probably planned on, pushing them into a higher tax bracket. Because everybody I talk to, are your kids successful? Oh yeah, our kids are doing great. All right, well, you're going to leave a tax bomb for them because if they're making $250 right now and they inherit another $1 million, you're going to add 100 and whatever to their ordinary income, and you're pushing them into a higher tax bracket. Who at the IRS do you love so much to keep sending them all this money? The exit side of those plans are terrible. So as an entrepreneur, when do I want to own that problem? Today or just, I'll deal with it tomorrow?
Today.
There's a funny comedian, Brian Regan, talks about, he went to the eye doctor and he goes, yeah, eye doctor, how is that not on the top of the list of to-dos? He goes, no, I'll see tomorrow. I'm too busy. I don't have enough time.
Yeah.
It's hilarious.
So the one thing I'd like to do about talking about this story and my financial journey, and it's not so much to like, it worked out and I'm, financially independent today, but how could I have structured it better with more assets is really the question. More ownership of assets, more depreciation, less taxable events. And it turns into where we start owning our capital. When we start owning our capital and our capital allocation and being able to measure our allocation, and that's one thing that's really attracted me to working with you, Matt, is like we start to really measure like how capital flows and the cost of capital. So if we go back into the time when I started really funding we could go as far back as when I started funding my 401k, it'd be a totally different story. But even if we went back to me buying the single family home and me building out a properly structured life insurance policy, heavy cash value on year one, say I put that initial $90,000 to $100,000 into the policy compared to paying down my 2.75% interest rate, I'd have $100,000 available to borrow from. And then, in my opinion, knowing what I know now, I would have still the sense of ease and comfort of operating my finances because I have $100,000 liquid compared to trying to drive my expenses down so much that that's the only way I can figure out. And I believe that's more of a mindset thing.
It's a mindset thing because it's been around for generations because of scarcity mindset and because of the greatest generation went through the Depression and they didn't want to be slave to the lender, which I understand. But to your point, if you had the $100,000 in a policy, hell, even in the bank, and you had a $100,000 loan, you have control over the cash versus your neighbor who takes the $100,000 and pays off the house. They don't. So the only reason you would do this is if you want control over your money.
And to add to, because I know you did mention the bank, the problem with it being in the bank is I always figure out how to buy a vehicle, or I find I, for whatever reason, feel the need to have a nicer car or something. It just starts to flow out of my
Yeah,
system.
we're successful. We want to show it. We want to live the life.
I deserve it, is what I would say to myself. But I think when I create this capital capture account where I have a place to store my capital, it's forever growing, guaranteed, uninterrupted. It's almost like I buy a piece of real estate in myself. And this is what we're talking about with the balance sheet item. Now this $10,000 is growing at 3 to 5% forever. And when I do borrow against it, it's through a line of credit that's borrowed against the cash value. And I'm able to still operate the same way on an unstructured loan. I'm able to go out and I could pay off debt, whether I could have paid off the debt anyways. But obviously we look at this now differently. We're like, okay, maybe we don't do that. Maybe we do buy the house down the street where I wanted to move into, and I have access to this capital now with favorable financing that works in my favor. So then all the same things could have happened. And what I didn't say in the beginning is that house, I actually had to borrow against the house to get the capital that I put into it. I ended up paying a higher rate later, paying the closing cost, all the things that happened, just to pull more capital out after I already paid it down. And then on top of that, I ended up selling the property after I borrowed against it 2 or 3 years later. I sold the property to be able to get access to more liquidity.
Yeah.
And that's what I believe what we're trying to solve for is we're creating a balance sheet that has all your liquidity. And when the opportunities show up, you're able to access the capital and be able to continue to operate in the same way while maintaining control of the other assets.
Yeah. So in the business world, they call that solvency. And solvency is greater than being debt free because you control the capital. And banks know this. But think about this. So like person A, they take their hard-earned money and they pay off their home. So now they have equity in the home. Did you know the equity in your home isn't yours? It's not.
Not until you sell it.
Exactly. Either you sell the asset or
Borrow against it.
Borrow against it. You have to go to a third-party lender, prove income, prove you have a job, prove all these things, qualify for a structured repayment process to have a lender give you the access. So the equity isn't ours. I love lines of credit, don't get me wrong.
Yes.
But the equity in the home is not ours. Versus if I were to take my hard-earned money, put it into my policy, now I bought a death benefit. My wife, if I'm gone, my wife could pay off the mortgage. But I'm going to put it into a policy to take care of my family. Then I'm going to leverage the policy to go buy a rental down the street. And now I'm going to have somebody else pay off the mortgage. And there's so many tax ramifications from that as well, which is where it starts to get more creative and fun. But what have I done? Is it more risk? Is it riskier? And this is subjective, but is it riskier to take all my money and pay off a house that doesn't create cash flow, my home?
I feel like it's more risky when you pay off your house.
Yeah, but I'm debt free. And this is why I got the title of my book, Don't Be Debt Free and Broke. You paid off your house. Congratulations. How are you buying groceries? Good luck. Versus take my money, buy a policy, family's covered, buy a rental, tax incentives, and then create cash flow to refund it all. The policy gives me the access to the capital and it protects it from the IRS and creditors. So I've increased my balance sheet and the control over my money with one of the oldest products that has existed in America.
Yep.
Again, you only do that if you want the control. Some people don't want the control. They say, I want to be debt free. I don't want any bills. All right. Have fun gardening when you're 62 years old and good luck on the whole fulfillment thing. That might be overrated. Who needs fulfillment in retirement?
So I'll add more to in 2025, so this is when I had 0 units. I ended up accumulating 600 units. And it came to a point where we were kind of running, not into, I would say it was a little bit of a liquidity crunch, but it was also looking to find where the capital is really what we were doing. And generally, when you have good assets, they build equity inside. So there's 2 properties that we had that had a ton of equity inside them. But the choice was borrow more out of them, or we could sell them to get the capital out.
Yeah.
And I believe those 2 assets were some of our best assets, best locations. And it's because of the lack of having access to capital is the reason why we ended up selling them. So it's kind of at what point do you want to be able to hold on to these assets when times are a little tough, market bounce back, and then we always have a plan until we don't, until we don't have
until you get punched in the face.
Until you get punched in the face, exactly. So that was kind of what happened in 2025 for us. But it was, we weren't properly structured as in having plenty of capital on hand to be able to either go get more or just really be able to, access more capital is what happened. So it's what I can tell you is the more access to capital you have, the more negotiating power you have towards those deals. So if you can pay cash, obviously you can get a better deal if you're paying cash for a house or if you pay cash for a mobile home park. But it's the one that has the cash makes the rules. And really you'll find yourself holding on to assets longer if you have cash on your balance sheet.
You do. And think about this. I think you're exactly right. And banks would back that. If you want to work with a bank and create any sort of leverage, you're going to need access to capital. And the best way to get a good loan is to prove you don't need the money. Hello, balance sheet.
Yep.
Here's an idea too. Now, this is not a prescription for anyone listening, but it's a hell of an idea. So tell me what you think about this. I have $1 million in my 401k. It's May right now. I take $1 million out of my 401k. How much taxes due if I took it out today?
None. They're not due until next year.
You're too smart for this shit. All right, you're too smart. So you're exactly right. None. Nothing is due until next year.
Ask me how I know.
So nothing is due right now, but I take $1 million out. Your advisor is going to say, how much do you want to withhold? And people go, I don't know, 30% plus penalty. So all right, 40%. So you realize 600,000. Man, this is why people go, I would never do that. Okay. Don't do it. But if I know that the taxes aren't due until next spring, I could take $1 million out today. And to your point, if I pay cash, I could probably get a good deal on something. Quick close, negotiate the price down. So let's say I buy a $1.1 million asset for $1 million in cash. I buy a mobile home park, for example, or a nice rental on a lake or the ocean, my 401cottage.com. I now have an asset that theoretically I could create a short-term rental, which creates active income, and I can do a cost segregation study.
Yep.
Okay, so I can offset some of the tax that's due off the $1 million distribution, which you lived through. Okay, let's say I do a cost seg study and I save $300,000. Okay, so now my income that year is down to $700,000. You follow me?
Yes.
Okay. Next January, we do a cash flow study and decide how much am I going to make this year. We do the cost seg study to reduce taxation. I now have a $1.1 million asset that I owe nothing on. I go to a bank and get a line of credit for whatever the tax bill that's left over. If there's anything left over, I'm going to use the mortgage company to pay the tax bill. So let's say I owe $250 in tax because I don't have a good tax strategist, which we do, by the way. But let's say I don't have a good tax strategist. I owe $250. I go borrow from the lender for the $250, use the lender's money tax-free to pay my tax bill, and then who pays back the lender?
The property.
The people enjoying the lake house.
Yep.
Now I have an asset that when I die, instead of leaving $1 million tax bill to my family, I'm going to leave an asset that hopefully is worth 1.1, 1.2, 1.3, and they get a step up in basis on that asset. So they don't owe any tax on that thing. And they get to enjoy it. So instead of statements, I get memories with my kids. Instead of market stress, I get vacations with friends and family.
And you get annual, tax write-offs and stuff like that.
And oh, by the way, the IRS wants you to do that.
Yeah.
The right way, obviously.
Yeah. So, the reason why I read this article about savings rate and then depends on how much you are able to save. But I've learned that cash flow increases savings rate, which sounds like logical, making sense. But the less you need to earn, the closer you are to financial independence. And really, that was my conclusion, that I was like, okay, if I can accelerate this, even pay the penalty, I can still get to my financial independence number faster because I have income offsetting like my own expenses.
Yeah.
So now my savings rate was like 30 to 40% at the time. And it went to like 75% overnight. Like just because I just bought a new property, I have cash flow. And, figuring out the payback structure, I've actually never thought of it the way you just said, but it makes complete sense to like, once we become owners of our system, the government likes to reward those people. I think that it's like when you hear about these billionaires not paying taxes, it's like because they own the system and they're giving all these jobs.
As Donald Trump said, that makes me smart.
Yeah.
He goes, he was on stage with Hillary Clinton. He goes, she's been a senator for 30 years. If she wanted to change it, she would. But the truth is that the cronies that pay her, that donate to her, are the same people using the tax code that I use. So if she wanted to change it, he goes, I'm not a politician. I'm just using the tax code she set up.
Yeah.
You don't have to be a Trump fan to recognize, there might be something behind what he's talking about. Dave Chappelle even talked about that. Did you ever see Dave Chappelle on Saturday Night Live?
Probably.
So he was hosting, in his opening monologue, he starts talking about, like, I knew that Trump was a badass when he was on stage with Hillary, when he said, yeah, I don't pay tax, and that makes me smart. And he thought, that mother.
Yeah.
And then everybody's like, no, we need to tax the rich. And Dave's like, man, I just got this money. I don't want to give this away now.
Yeah.
So, but that's a great segue too, because what you're talking about tactically, like in theory, makes a lot of sense. Tactically, how do we do it? So for everyone listening, there's a link right below the podcast. Set up an appointment with Cashflow Architects. We'll walk you through the process of how to change your internal banking so that you can create cash flowing engines long before retirement to offset that financial gravity that eats away at your paycheck. So your savings rates gets increased by funneling your money a different way. All you do, we just change the way money moves throughout your system. And tactically, we'll show you each one of these money moves with the sole purpose in the end is to increase your savings. And I've seen it go through the roof for some of our clients where they're saving more and they're not just going to go buy and sit on something. They're creating cash flow to offset. Now they can increase their lifestyle without getting paid more from work. Their salary is going to increase eventually over time. But if we can create a separation of what you spend and what you're making and capture that to create cash flowing engines, to your point, Glenn, that's how you create financial freedom. That's the exact process that we set up for people. A lot of people go, Matt, what's Cash Flow Architects? Cash Flow Architects is a company that's set up to teach people how to create cash flow before retirement years, incentivized by the IRS, so you can create a lifestyle that you don't want to retire from. It's going to include things you've heard of in the past, but the way we structure it all is not even that unique. There's a lot of people out there doing it, but we have a really nice system that walks you through the next right step, depending on where you are, because everybody's at a different position.
Love it. I'm excited to meet people and change lives.
I love it.
It's going to be awesome.
Glenn, thank you so much for joining me and sharing your story. You've gone through a lot, and you got the best teacher in experience. And I joke that experience is what you get when you don't necessarily get what you want. So you've gone through it all. You've seen it firsthand, and the knowledge that you bring is great for clients. So thank you. That's when you say you're welcome.
You're welcome. I'm like, I don't know where we're going with this. Yeah, I'm excited and looking forward to meeting people.
All right, brother. Good seeing you. Everybody listening to this, click the link below, set up your appointment. It's absolutely free. We'll teach you the cash flow system. What I call the cash flow blueprint, and we'll go from there. But Glenn, thanks so much, man.
See you later.
All right, bye.
Thank you for listening to the Capitalizing Your Life podcast. Please rate, like, subscribe, leave a comment, and share with someone who you think would enjoy listening.